Hello, I'm Kevin from Untied, the UK's personal tax app, with an extended and animated tax tea break. When it comes to income tax, we're often asked how personal allowances work if you're both self-employed and employed. If you use Untied, it all gets worked out automatically using the same basis as HMRC calculations. But this is what's going on behind the scenes. We'll explore this with my two friends, Seth and Beth. Seth is self-employed, and so is Beth. Beth earns the same amount as Seth from her self-employment work, but Beth also has another job where she earns a salary with tax deducted by her employer. It means she also has employment income. Both Seth and Beth have a personal allowance of about £12,500, which is what they can earn before they need to start to pay income tax. Let's begin with Seth and see what happens next. Seth only has self-employment earnings, so his personal allowance of just over £12,500 can be used against his self-employment income, and he'll only pay tax on what he's earned above that personal allowance. Seth will file a tax return telling HMRC what he's earned and pay tax on just this amount. Let's welcome back Beth. Remember, Beth has the same self-employment income as Seth and a job where she receives employment income. She also has a personal allowance. For Beth, the personal allowance is applied by her employer against her employment earnings. Her employer will deduct tax on what she's earned above her personal allowance. So that's the tax taken off by her employer. It means there's no personal allowance left to be used against her self-employment earnings. When Beth prepares her tax return, she'll be reporting both self-employment and employment income on that return, even though HMRC already know what she's earned from her employment. Let's see what this means in terms of tax Beth needs to pay. Beth's employer has already taken off tax on the amount that she earned above the personal allowance. There's no more tax to pay on her employment earnings. She's not yet paid any tax, though, on what she earned from self-employment. There's no personal allowance left for Beth to offset against other earnings. She'll need to pay tax on everything she's earned from being self-employed. Beth has a higher tax bill than Seth because of this, but she has also earned more money thanks to the employment income she's received. But what if Beth is earning less through employment than the personal allowance? Well, let's take a look at what happens now. The first chunk of the personal allowance is applied against her employment income. A little bit is left over to be used against other income. Note that Beth's employer won't generally take any tax off because she's earning less than the personal allowance. In some cases, though, if the employer doesn't have full information, they may end up deducting some tax, which she will get as a credit or repayment. But the key thing is that the balance of the personal allowance can be used by Beth against her self-employment income. When it comes to completing her tax return, Beth will still need to report both employment and self-employment income. Beth will only be paying tax on the balance of her self-employment income above what was left of the personal allowance. So however you earn, you're entitled to one personal allowance and you'll pay income tax only on what you earn above that personal allowance. From Seth, from Beth, and from me, thank you for listening, and we hope you enjoyed this extended tax tea break. Putting you in control of your taxes. That's Untied.